Hello again, everybody. So, a question for you. How is your portfolio doing this year versus the S&P 500? Have you looked at it lately? Actually, a better question is this. Who cares? I'm serious. This is not a rhetorical question. It does have an answer to who cares? Nobody should care. You shouldn't care how your portfolio is doing against some benchmark like the S&P 500 or the Dow. You would think we should care because that's all we seem to hear on financial news networks, and we read about somebody comparing their portfolio to the S&P or the Dow. Now, don't get me wrong. Maybe a portion of your portfolio you can measure it against a benchmark. So if you have some sort of large cap growth fund or whatever, and you want to measure it against the S&P or the Russell 1000, that's fine. I'm talking about your overarching diversified portfolio. It makes no sense to compare a benchmark like the Dow or the S&P to your own portfolio. We have to remember how these things are constructed, and then you're going to understand the silliness of this, all right? So stay with me. I'm going to kind of tell you how the sausage is made, how these benchmarks are constructed, so by the end, the light bulb will go off. Yeah, why am I ever worried about what the S&P is doing? All right, so let's get right into this. Okay, so the Dow Jones Industrial Average, it is the oldest market index in the world. It was started way back in 1896 by this guy, Charles Dow, who also is the founder of the Wall Street Journal more than a century ago. Kind of a big deal in the history in the world of investing. Now, the quirky thing is, for the Dow, it is weighted by the price of the stock, which means the highest price stocks have the most influence on how the Dow performs. It makes no sense. In fact, let's put up a picture right now. There are your 30 stocks that make up the Dow. I guarantee you probably heard of most of them. And you'll have from the highest price, as you can see, it goes down to the middle priced and then all the way down to the ones that are the cheapest priced, if you will. It doesn't make any sense, though, that's how we rank these things. In fact, let's go ahead and put up the slide of the top 5 in terms of their price of their stock prices. You can see it's Goldman Sachs, Microsoft, Home Depot, Visa, Sherwin-Williams. So it's not the largest companies, right? It's not the ones with the most sales or the net profits. This is purely by the price of the stock. And as you can see, there's Goldman, leads by a long shot. Now, one stock that had been in the top 5 for quite some time, in fact, it was going back and forth between Goldman and some others as the highest price stock, and that is United Health. United Health had touched $600 a share earlier in 2025. Let's take a look at what just happened recently. Wow. Folks, I don't know that I've ever seen a Dow stock, one of the best known companies in the country, fall like that. That is a better than 50% crash in a month's time. That had nothing to do, by the way, of that murder of the one of the top executives of the company last year on the streets of New York City. Yeah, the stock took a little bit of a hit right after that, but then it went right back up, hitting all-time highs. No, the chart that you just saw right there and the big fall off happened really for 2 reasons. Number one, earnings, not even close to meeting expectations. That company's had some real problems. But then recently, as you may have heard, according to reports, they could be the subject of a Department of Justice investigation into Medicare fraud. Not good. Right now, that's just alleged, all right? But that caused also that stock to drop. I point that out because United Health, a one-time $600 stock, now trading in the 200s, has caused the Dow to underperform because of one company. So let me take you back to April 17th of 2025 and show you one particular day in the history of the market and United Health in particular. So look at right there. You'll see that the S&P was relatively flat. It was up about 7 points that day. But the Dow plummeted more than 500 points. Why? Because of United Health with a bad earnings report. It was down $130 per share that day, equating to roughly about a 22.5% crash. So I ask you again, why in the world would you compare your own portfolio to an index that can be affected by the crash of one company? You wouldn't. Now, the S&P 500, it's a little bit better constructed, frankly. First of all, it has 500 stocks, so it's more diversified, but it's weighted in its own way a little bit differently. It's by capitalization or the size of the company. One problem with that. Here are your top 6 companies right now in the S&P 500. My friends, do you see any connection to these 6 well-known stocks? Yeah, they're all basically technology related. So here we go again. Yet another question. Same one, really. Why would you compare your own portfolio that has stocks and bonds and maybe some commodities and cash to an index like the S&P that is almost entirely run top-heavy by tech stocks? It makes no sense at all. So please stop listening to those who ask you that question. How you doing versus the S&P? You just look at them and you smile and you say, my goals are intact. I'm doing very well this year. Thank you very much.
Thank you very much.
Well, you're welcome, Elvis. And thank you all for continuing to support the Simon Says podcast. The numbers continue to go up every week. That also includes my weekly commentary, which, believe it or not, I've been writing now for over 26 years. I can go into a lot of depth and detail on those things. So if you haven't subscribed to that over all these years, please do so. Here's how you do it. You just email me right there, and just in the subject line, just say, sign me up for the commentary, and you're in business. That's it. Talk to you next time.